Hello, everybody. My name is Alesh Eisner, and this is my friend Rob. We thought we would do a something a little different this time, a bit of a podcast format. So this is going to be a series of 7 questions in part one, 7 questions in part two. We'll just read out the question, and then we'll both answer it. We'll debate. We'll ask questions and hopefully everybody will get some good value out of it. On to question number two.
Nice. So let me ask this one. What were some of your successes and some things you would have done differently? And tell me some of your financial mistakes and what have you learned from these mistakes?
Well, I think the successes have been investing, keeping to it, and getting good results over the long run. I'm quite the long-term investor with the majority of my portfolio, so I think that's where my successes came from. And watching my net worth go up in Quicken, as it keeps going up and up, I see that as a success, and it's quite motivating. As far as mistakes, I can think of three. Uh, Back before the dot-com crash in 2002, 2003, I was working for a software company, and they had an employee stock purchase plan, and they also had uh, shares, options that you could get for the company. And the company stock price kept going up and up, and I had all these shares, and I had all these stock options, and I never thought to sell them because number one, I was working really hard. Number two, I didn't really need the money, and the price seemed to be going up. And later in hindsight, I figured out that I had the bias that whatever is happening today is going to continue forever. And of course, totally out of the blue, the dot-com crash came. My company got hit with it as well, even though they were actually a profitable company. They were not a dot-com startup. They were a software company which was making good money, had 700 employees, so they were good. But the stock tanked. Uh, I I could have, like, I lost out on about $100,000, which was a lot of money at that point. And so I learned from that: sell when the stock is high. Don't sell when you need the money because the stock may not be at its optimum price at that point. So that was a hard-earned lesson. Uh, the stock went up to $70 a share. I had 2,000 shares, both as options as actual shares. It went up to 70, then dropped down to 50, then went back up to 70, and then went all the way back down. And I kept with it, and I sold it for $2 a share. So
Okay. And what,
it
what is
went.
it now?
Oh, they got bought out. There, it's the company doesn't exist anymore. The technology still does, I believe. Uh, in fact, one of my contract jobs was doing the same kind of work that I had been doing for that company for many years. I had this contract with a company in the U.S. where I kept configuring their software to make to add new modules and so on. So I mean, despite the stock crash, I mean, there was some good there. So I think that was, as far as investing, that was my number one mistake was, um, not selling when the price is high. But the fact that that company allowed me to get into contracting, and I sort of had side hustle, even though back then they weren't called side hustles. I had kind of contracting on the side as kind of in the back of my mind, which allowed me to go contracting full time. Um, Mistake number two would be, as I had mentioned, that I ended my relationship, which, despite a prenup, still cost $250,000. We were sort of heading toward millionaire status, and then suddenly it was down to 700. I'm like, oh, that wasn't good. That was expensive. But general warning: don't get divorced. Uh,
I think I think there was a stat that says like I don't know 33% of a
I,
couple gets divorces.
I heard it was in the high 40s, like
Yeah,
even
I don't.
50s.
I choose not to believe it. But, uh,
To be perfectly honest, and please, personal opinion, I don't know why people get married. Like if somebody said, okay, you need to go across the street and you have a 50-50 chance of getting hit by a car, would you step off the curb? Like
it's
I wouldn't, but yet people keep getting married. It's
yeah. If
like
you want
where's
things
the
to come in your favor, then it's hard. But the social norm, right? Like when you love someone, you have to marry them. We call it.
yeah, but it's like, oh, where's the line where I can lose half my stuff? Oh, where do I sign up? Uh, Anyway, in any case, when you do get married, make sure that it's forever, because it'll cost you a pretty penny.
I don't know. I don't know how you can make sure even through investing you can even be so sure of an investment and they can turn the other way. Just like anything can happen in life. So
Yeah, actually, if I can relate marriage to investment, I attend several or a couple of investment clubs. I think he joined us at one of our meetings, and there was a gentleman who was coming out, I think, from Abbotsford, and he's just like, "Sorry, guys, I'm going to have to quit. Like, it's too far for me to go." And he just sent us a nice email, and he wrote, "My best investment ever, marrying my wife," and then in brackets he put "still holding." Which I thought was very very cute, that was his best investment, and he was still holding on to that investment. So if you do get the person that's right for you, it's awesome. If you don't, then it'll cost you. It'll
yeah,
cost you.
yeah.
We did have a prenuptial agreement. Otherwise, I would have lost an extra $250,000. But because
Just do. I don't know how this thing works. I'm not married, so
I,
so this prenuptial agreement is something you sign before you get married, I guess.
yeah, before the nuptials, before the marriage,
Okay.
we were never married. We were common law, and before we bought the house, we signed an agreement. I wrote it, and then we just each took it to a separate lawyer, because it's not worth the paper it's written on if you don't get independent lawyer consultation. Like, you cannot even both go to the same lawyer. And lawyer checked it. You can make it whatever it is, like whatever you want it to say.
Okay.
The trick is, of course, getting the other person to sign it, right? Um, so what we wrote ours as was, whatever we have going into the purchase of the house is separate, and then
Okay.
from that point on, whatever money we make, whether it's the appreciation in the house or it's your salary or whatever it is, then that goes 50-50.
Oh.
That was kind of what I thought was fair. Is like, okay, our lives are now joined. Let's let's have everything 50-50. But whatever I had going into it was mine.
So
uh,
let's say if you had somehow a quarter million in stocks, like and it appreciated in the 10 years. So do we calculate it without the appreciation? So this 250 is still mine, but
yeah,
anything on top
yeah,
of that.
good,
Okay.
good question. So the appreciation in the assets that were being called out as being separate, that was also separate.
Oh,
But
okay. Okay, so
but
those assets are pretty much on its own. It's not taken in, but okay, I get it.
yeah, in the readings that I did prior to that, there was some question that if the assets changed form. So, for example, if I sold something and
Oh, right. And
bought
then
an
real
investment
estate.
property, that investment property now could be seen as being 50-50.
Oh, wow.
So I had to be sort of not careful. I didn't go out of my way, but I made sure the assets stayed in their original form, meaning mutual funds. and that it was being kept very separate and never drifted into a common checking account.
Okay.
But yeah, so that stayed separate. But any salary we made, or for example, the house that appreciated uh, significantly when we owned it for the 5 years, that all ended up being 50-50. So,
And
I
I
mean,
guess if in the meanwhile you guys started a business together and that turned into like a $10 million company, that's also split. No, even if that company is only yours.
well, I guess that would be 50-50. And frankly, I was doing the side hustle contracting, and that all kind of went into the pot as well. And I was the only one doing that. I also made a higher salary than she did.
Yeah.
But I think when you're joined, I think that's fair. And
Yeah.
so that's sort of what we went with. Yeah.
Okay. Let's
Uh,
talk about the third mistake then.
yeah. I was just gonna say prenups are usually not seen as being very romantic because
No.
you're, but it also you could spin it to yourself and to your significant other in that I want to make sure that you're marrying me for me, not for my assets. So you can look at it that way.
Yeah, I mean, it's an open relationship, right? So you should be able to talk about anything that bothers you and or the other person. So yeah,
Yeah, and I mean, if there's a discrepancy between your assets, or if somebody has significant debt, for example, going into the relationship, you would want to account for that. It's like, okay, we paid off your debt, now you're leaving. That should be a negative against how much money you're taking out of this relationship. So
it goes both ways. Yes. Okay.
yeah, so I thought it was fair. I mean, my ex obviously signed it. We abided by it.
Yeah.
There were, other than the consultations on the prenup and on the uh, exit agreement, I
Yeah.
can't think the exact wording for that. There were no lawyers involved, so there wasn't any fighting, and there weren't any
It
additional costs.
just
So.
just out of curiosity, so how about how much of lawyer fees does it take to like initiate this prenup and the exit and all this package? Is it in the, like the 10,000 range or 50,000 range or just out of the ballpark?
Yeah, I think at this point, if I was going to live with somebody or marry somebody, I would get a lawyer to draft the whole agreement from scratch, and then I think it would be in thousands.
Okay.
I wrote both the prenup and the exit agreement myself, and then just had a lawyer check it.
Okay.
I think it was like a couple $100.
Oh.
So because the lawyer just kind of read it, like I copied and pasted it out of a BC uh, prenuptial template,
Yeah.
right? And then added in a couple of clauses, and then had an appendix with the list of all the assets. So it was fairly cookie cutter.
Okay.
At that point, there wasn't that much in assets. Now it's 3-4 times that. So I would actually shell out for the lawyer because uh, yeah. And the other thing about prenups, not to beat this to death, is that they do only last about 5 years. Like you can't get a prenup, live with or marry somebody for 30 years, and then say, okay, I've changed my mind, and after 30 years say, here's a prenup, I want all my stuff back. Like there would be no court that would uphold that prenup.
Well, it's only so the contract is only binding for 5 years.
It's only binding. There's no dates on it other than the signature date. But as far as it being valid, uh, it, the lawyer told me about 5 years. Now, having said that, I also ran into a coworker, and we started talking finance and so on. And she said that she had a prenup with her husband because she had more money going into the marriage, and that every 4 or 5 years she had him sign an extension. Now, whether that's valid or not, I could not tell you. I'm just telling you that's what she was doing.
Oh wow,
So
that's good to know. Yeah.
yeah, I would definitely check with a lawyer on that, because that seems like just because you can get your spouse to sign something doesn't mean that it's valid, right? There's a difference. If it gets challenged in court, the judge can say, yeah, you're kidding, right? So I have no idea.
Okay.
There you go. Good, good. So something to look forward to. And sorry, hopefully you're getting some good information about
Sure.
this as well. I mean, there's tons of info out there on the net. It's super location specific. Each province and of course each state in the U.S. has a completely different set of rules governing stuff like that. So make sure you're looking at BC.
Okay.
Um, anyway, just for my third mistake is I participated in a couple of flips, real estate flips on Vancouver Island. First one was just they moved a staircase, took out a wall. It basically took 2 months to put some lipstick on the pig, as the saying goes, and we sold it within a month. So the whole thing took like 3 months. Me and a partner made money on it. It was a joint venture. It was 50-50. So we split about 30,000 on that one. So we each took home 15. The person who made the most money was the realtor, because he was our buyer's agent, and then he was our seller's agent. So he got the commission all the way through, and he didn't have any money at risk. Uh, so being emboldened by the success of the first one, and me sort of ignoring the huge cost overruns that happened during the flip, where my partner estimated here and 40% there was a cost overrun. I sort of like, no problem, and I got into a second one, which included subdivision. So we bought an 8,000 square foot lot with a house on one side, and we're going to split it into two. That took 2 years to complete, because the city of Comox on the island took an unimaginable amount of time doing everything, and made us jump through so many hoops. And again, made money on it. The estimation of the work required was even worse on my partner's part. I was the money. He was the construction know-how and the general contracting kind of thing. So made money on it. The amount of stress and hassle and risk involved would not make me want to do it again. Different location would have different rules as well. Like each city hall has similar procedures, but they could be different if you go to a different city hall. So and it takes a huge amount of time. So like we had 3 sets of renters in there, and then it was just sitting empty. It was just ridiculous. So yeah, I would never do that again. So I guess that was my third third mistake.
Okay.
So what about you? What sticks out in your mind?
So the successes, it's mainly being able to use leverage at the right time and the right things.
Hmm.
That's like the ultimate multiplier to save you time and money. And
Just with real estate, or with other assets as well?
yeah, real estate is with the mortgage. For the stocks, is with the stock options
Okay.
and with margin. So all these are in the stock space, the stock option and the margin. And so yeah, that really gave me a good multiplier on things to save me time. And the mistakes, it's there's a there's a few for real estate is just not being able to hold on to the real estate. Sometimes you want to save the trouble. I believe I sold my first piece of a condo when I left for China to do my business. I say, oh, I just don't want to deal with it because I'm not here. I want to get my family to take care of the rent and stuff. I'll just sell it and then just get my mind off things and just take my money elsewhere and do my business. Like looking back, if I just held on this past 10 years easily doubled or tripled in value easily, on top of like the yield back then was like a 7% yield right off the SkyTrain. Like it was no brainer looking back, but who would have known? I took this cash, I made have grown it bigger, faster in my business venture and my stock investments. But I think it's a mistake because a lot of people, they do recommend holding to real estate forever, and just because generally land appreciates and then you get rental income on top, and is a great diversification as well. But back then, I just want to go all in on a certain thing, and I chose to sacrifice my real estate.
But hindsight is always going to be 2020. If I had bought Tesla stock 10 years ago, but
Yeah,
I never look at any investments after I've sold them because 50-50 chance you're going to feel bad that you missed out on something.
yeah,
There's no way anybody could have predicted an annual 30% spike.
yeah,
Uh, I sold just before that spike as well. The house I was living in before I downsized to a condo, same thing. And I'm like, well, the condo went up in price. Uh, I can't beat myself up about it. So
yeah. And another thing is because I sold it, it yeah, I can't really justify it into like getting back in because the switching cost is so much, like the realtor fees, everything, legal fees is just it all adds up. Let's say everything adds up to like 3 to 5%, and that's like a year of growth. And there's a lot of opportunity costs there, and it's just the cost of switching is just real estate is is a different beast. It's like you you tend to want to buy it to hold on forever because of the switching cost, and um, yeah, so that's another thing with real estate. And there's one more. I bought something I think a couple maybe 5 years ago, and the whole intention for it is a larger piece of land, as you said. There's it's like 9,000 square foot, and the whole intention of it is to get the whole block in the same mindset of switching it into row houses.
hmm,
The city plan, everything was approved like 2 years after I bought the place. Everything was in line. I talked to a couple of my neighbors. I think I got the first four houses down and the same vision of selling it to like a developer. but but it's hard to get people like to really do what they say they would do because
yeah,
because I was in the corner lot, and then my first approach was my second neighbor right there, and he was like, "Oh, that's a great idea," but then a year and a half, 2 years out, he say, "Oh, I just want to build my own." I just want to build my own like fourplex or threeplex instead of having the vision of rebuilding the whole block. You just
so
it's it, it
you wanted to consolidate a bunch
consolidated the whole
of
block.
a whole block and then sell it to a developer to build an
Yes,
apartment building.
yes,
Okay, and you
yeah.
only
And
had one lot in.
I have the four of the eight houses like kind of in agreement, but then the second house backed up, so there's nothing much for like the rest of the block to do anymore.
And
So
you didn't actually want to buy up the properties.
no, I had the corner lot, but
Yeah,
I'm just like forming partnerships with the other landlords, I guess.
and so all of you would kind of go in together and you would all sell it together to a developer. Were you planning on rezoning it as well, or did you?
Yes, yes,
Okay,
and it's the city approved all the rezoning and everything. No, I mean like the in the official city plan,
yeah.
it is all rezoned as row houses. But then so we can execute. But then this person just had a different vision. He just wanted to build his own fourplex. Eh, I don't think I'll lose money overall because this one piece of land, like say 9,000 square foot, can still be rezoned and built as like a 4 unit
Mhm.
place. So I definitely won't lose money, but I definitely I can't make as much as my vision could have because it's out of my control. There's so many moving parts
Yeah.
that, that are in
Yeah.
this deal. Like I didn't have there's no way I could have like funding like 10 million to buy the whole block. Even then, some people would choose not to sell because they know what your vision is and they know they can mark up the price higher because they know they're the missing piece.
Well, you offer them enough money, they'll sell, and you'll still
Some
make
people
money.
still won't. Some people still won't.
Yeah,
In this, yeah, the land development game is very tricky.
it's tricky, but from my experience, even if the city had earmarked the whole place for row houses, you still have to go through the rezoning process and application,
Yeah.
and so that would have taken a year.
Yes. Yes. Yeah, and
And
that's
and
what the
public,
neighbor,
sorry.
and that's what the neighbor did for the past year or so, and he did get it rezoned. So I wouldn't think there was a problem. There would be a problem to rezone the whole block to pursue my vision, but ultimately it's what it is. So
Yeah, it just ends up taking a long time, and there's public consultations and things like that. I actually invested 20,000 into something similar, but through a third party, through a developer called Yorkton, literally around the corner from where I live. They bought 4 properties, which were individual. They said for $8 million, so each one was 2 million, which I'm like, really? They're not really huge properties, and one had a house which was not down, and anyways, and they were going to rezone all 4 of them, and then they were going to either build 2 apartment buildings or they were going to sell it to a developer, and then I would get my money back plus something.
yeah,
So, I mean, you can invest that way as well. You don't get all the return, but you also don't get all the hassles. And
yeah, and did that plan go through?
no, it's still in progress. COVID certainly delayed it, but at the lovely pitch meeting breakfasts, the uh, the dates they gave were hilariously optimistic. And then
Well,
COVID
that's what
happened,
they
and
tell you, right? They overpromise and never deliver or under
yeah,
deliver.
yeah, I'm sure eventually it'll go through.
Yes.
Uh, and they actually said they would be paying like 5% interest on the money from the time that they got it. So I'm like, okay. And there should be some sort of an uptick as well. But
Yeah.
all right. So real estate, uh, it doesn't always work the way you want it to, and people don't always do what they promise or what you would like them to.
Yeah, that's a real
Yeah.
estate side, and for the stock market, something happened this year. I made a video about it, of how I lost $1 million in my TFSA account. It's certainly nothing to brag about because because I don't know if anyone can lose $1 million in the TFSA. Um, yeah. So this all happened in March during the crash, but
Yeah.
I didn't lose money during the crash. I actually made money during the crash. In that video, I stated my account went from I think around 230 to like 530 during the crash, to right down to the bottom. But I I predicted the markets. I got emotionally attached. I said, "There's no way with the economy like this, the stock market can bounce all the way back up to to before prior to COVID, back prior to March 2020." And that's when I did shorting. So it bounced back halfway, and then I said, no, it seems about right. So any overshooting will just be it's kind of ridiculous in my mind back then. And I shorted, and I lost back pretty much everything I gained during that time. And there is another thing is opportunity costs and how when you make a play like this, it affects your emotions and you don't do things according to plan. I had plans to execute and with my stock option strategies where I usually get my home runs, and I had plans to just buy the huge stocks, MAGA, Microsoft, Amazon, Apple, and Alphabet, and just buy the options every single month, dollar cost average, and hold on to it for 2 years. And and if I could have done that, those options would have made, I think by now, close to $1 million. So there is there is my opportunity lost. I didn't lose it physically, but I could have made it if I executed to my plan. But everything switched. Like that was in my playbook. I didn't like make this up, but it switched in the midway because of how emotionally attached I was to all these Trump tweets and all this crap, and everything didn't make sense to me. So I that was a mistake this year. It's not the largest amount I lost or made. It's something that's more recent. Yeah.
Well, so you learned not to try to foretell the future, I guess, from the shorting, that to try to time the market perfectly hardly ever works.
I think it's more like don't predict things that like you never got it right before. Like I never predicted economic events. I looked at companies separately despite the economic conditions. But in this play, that's all I looked at. And and that was a downfall. Like if I just stuck with my plan, I looked at the companies, I see value in there, I hold on, then I could have made the money. Easy.
Okay. Well, uh, I mean, as a counterpoint, I mean, I agree with you. Other than selling a few puts, I'm not really that uh, courageous of an investor. I buy and hold, and I do the dollar cost averaging as well. But sometimes, if you swing for the fences, sometimes you'll hit the home run, sometimes you'll miss the ball entirely. So
Yeah.
as long as you're aware of that risk, and it's a calculated risk, and it's one that you're comfortable with, and you're not going to have to sell something when it's dropped 90% in order to buy groceries. I don't really see anything. I mean, it could have also turned out great. Yeah.
It definitely could have. It definitely could have made me 3 mil easy, but
So there you go. There you go.
yeah, so yeah, the lesson is just manage your risk and just know it beforehand of like what your downside is, and you can cap your losses there and just leave your upsides open. Yeah, just do it that way.
Well, if there's a chance it'll go up, there's also a chance it'll go down. Usually, roughly the same percentage amount.
Uh not with these home run plays because it's managed. So if I put in, let's say, $100,000 on this play, the max I can lose is 100, but the upside could have been 1 million. Like that is the kind of home run play we call. If it's not this type of like risk and reward, then it's just like flipping a coin 50-50, like gambling at the casino tables, 1-to-1 odds. But I was swinging for the fences, as you call it, 10-to-1 odds. But
You're buying calls then.
buying
You're buying
puts
puts
when
for it to go down.
the market bounced back halfway. I said it wouldn't go up and cross the all-time highs. I said it would go back down a little bit, at least another 20%. That never happened. It just kept shooting up 50%. So yeah, that was my play.
Okay. Well, the problem with options is that they expire, and that's why you get the multiplier effect. But also, if you're not right within a couple of months or however long your options were, that's where everything goes away. But yeah, you're right. There's the multiplier. So you took a chance. You missed.
Yeah.
Um, Next time you'll guess right again.
Yeah, I wouldn't focus so much on economic events anymore. like when things happen, when they dip, I would just kind of do what you do, and I do what you do. Like I buy more, but in my dividends account, so I have different plays in different accounts. That's also like balances my risk as well. Um, yeah,
Yeah, you can do things like that with 5, 10% of your portfolio, and if it doesn't go your way, then it's not that huge a loss. But there's true gamblers out there who do that with 60% of their portfolio, and
for sure.
that's when they get into trouble.
Yeah.
All right, do you have one more
No,
successes or
I think
mistakes?
that's
That's
good for now.
that's it. Okay, on to question number three. What originally sparked your interest in personal finance?
Personal finance. I think growing up as an in an Asian family, we're just taught to live below our means and just some people would call it just be cheap as cheap as possible. But like there's nothing wrong with it. I'm happy. Like this shirt I have is probably like 7, 8 years old. It's got a hole in the back, but who cares really? Like it still does its function. It covers up more than 90% of my upper body. So there you go. And so what sparked an interest? It's it just I think the compound effect is like a huge thing. Once you kind of once you're able to visualize what a snowball effect can do, how your money can like grow itself over time and how it can just magnify itself, you kind of get addicted to it. And then like Alesh, you start buying these dividend stocks and you just keep collecting and holding, and eventually the dividend itself can be like 100% return on your investment, which means if you bought the stock for a dollar, maybe 40 years down the road you're collecting a dollar every single year. So that's like how powerful this whole dividend growth investing strategy is. And personal finance, as I was making more money, like either through my net market cash jobs or my other businesses, I had to kind of distribute it somewhere. So, and real estate and going all in real estate is just like I've made mistakes on there, so I wouldn't do that. So I've found other avenues like stock market or even cryptocurrencies. I've played with all those, and that's just a way to diversify your assets and to learn new products and kind of like stay in the game. So that's how I got into the space.
Okay.
Yeah, how about you, Alesh?
Uh, yeah, coming from Eastern European immigrants, my parents were quite frugal. I think it might be the world over. I don't know if it's just Asian or anything. I think it happens to everybody. Uh, so yeah, the frugality was definitely there at the beginning when we first arrived in Canada. My mom went grocery shopping to three different stores just to buy stuff that was 10 cents cheaper than
Yeah, I still
everywhere
do
else.
that.
Well, I guess it depends how much you value your time, right? Uh,
Yeah.
is like could I have spent that hour that could I have spent it making $200 instead of saving $5? But yeah, I do the same thing. Still, it's like, oh, the avocados are half the price over there. I'm gonna go over there and not buy them over here.
Yeah.
But um, I think with the investing, I started learning and educating myself after having a few mishaps. So, for example, the money that I first invested with that financial advisor I spoke of, I didn't know that he was putting it under deferred sales charge. So then, when I wanted to sell the mutual funds to buy that house with my ex, I got hit with 4% deferred sales charge because I sold those mutual funds too early, and I was totally unaware. I was totally unaware how that worked, or that he was charging me front end charges as well. like you just don't know. And then later I remembered, like literally years later, I remembered, oh, that's what he meant. He told me about it. I just didn't comprehend it. And so it ignorance costs you money. I mean, everywhere you go to the car mechanic and you don't know what he's pointing to, that costs you money because they know it's like, oh, and you need this and that, oh, and you should also fix that before that goes, and you're like, oh. So same thing with investing, right?
Yeah.
And so started educating myself, reading articles, reading books. uh, I started with The Millionaire Next Door, which is sort of a classic that a coworker recommended.
Okay.
Yeah.
I was just checking if I had that book here, but apparently not.
Okay. I was like, if somebody's breaking in, let me know. And I also read The Wealthy Barber, which is another classic.
Yeah,
So just, eventually I got to,
that's your wealthy barber right
there
here.
you go, Returns. Yeah, that's the
I have
second
a
one.
whole stack of books here, so.
Oh, good for you. Uh, I mean, for beginners, it's a cool book. I mean, both The Millionaire Next Door and Wealthy Barber you could summarize in 20 pages each. Like you don't actually need to read the whole book. But yeah, uh, frankly, I always spent way less money than I made. Uh, Kind of in the last few years, it's been like living on 15% of the money that I'm earning. So that whole creeping up of your lifestyle as you make more money, that's never been a thing with me. So yeah, frugality I think I got from mom. So that's that's really how I got into personal finance.
Okay. So you mentioned this financial advisor. He pretty much charge you front end, back end, and annual charges. So as much as he could milk you, he did.
Uh, Actually, yeah. I mean, back then, back in the late '90s, there was no visibility.
Oh,
There was what do they call it, CRM2 or something, where there's way more disclosures. So he's like, he put everything on deferred sales charge because clients don't like being charged stuff up front, which okay. But then when I needed to get my money out, that's where the mutual fund company dinged me 3, 4, 5% depending on when I put the money in. And he goes, well, you didn't tell me that you were going to need the money out in a few years. Since you told me, now I'm investing for you with a front end. And I'm like, so great. So now you're charging me front end two or front end three. I frankly don't know. Right. So he was charging me money up front so I could take the money out at any point. But instead of $10,000, now he was putting in, 9,500 or something like that. Plus, yeah, there were annual fees to the brokerage, not even to the mutual fund. Uh,
wow.
and
Maybe
then,
maybe mutual fund as well, right?
I'm sorry.
Maybe for the brokerage and the mutual fund.
Well, the mutual fund always had its MER,
Yeah.
but
So that's yeah. So
but
it's
but yeah, that brokerage had something, and then for RSPs, you were paying another $200 for some sort of a wrapper, and it was just stupid complicated that nobody understood. And
yeah.
every time you did something, you paid more money, and I'm just like, okay, I really need to know what's going on. I like just personally, you don't like being ignorant,
Yeah.
right? And totally dependent on this person who later I found out doesn't have your best interest at heart. So
Well, I also have friends who rely totally on their financial advisors. Maybe the industry is better, more transparent now, but a lot of people just don't want to partake in this area of their life. They want to just hand it off to someone and
yeah.
just kind of delegate their responsibility, their financial responsibility to this person.
Well, and I think you have to agree by the time you get to the kind of net worth that you and I have, taking care of our assets becomes sort of a second job. So there's a lot of work there. So I can understand and
Yeah.
note both you and I are single with no kids. So I do understand why somebody who works, 8, 9, 10 hour day, they want to come home and they want to play with their kids and talk to their wife as opposed to reading articles or researching mutual funds. So I mean, I get that, but I think with financial advisors, it's the same thing as with accountants and lawyers and mechanics. You want to get one that you can trust and that will tell you the truth and not rip you off. I mean, the stock market can rip you off all on its own without the financial advisor piling on.
Yeah.
But you want to get one that, like, the financial advisor wants to make money. They want to feed their family too. So I understand that. So they're not going to sell you index funds. They're not going to sell you do it yourself mutual funds that don't pay them a commission.
Yeah.
But they should sell you 5-star top performing funds that maybe pay them a little bit less commission rather than selling you 2-star funds that pay them top commission. So as a beginner, I actually went to the library. I'm like, oh, here's a book from Morningstar, and I read a book that Morningstar, the research website, published and explained how their star rating system works, and I'm like, absolutely. And that's where I started doing my research. And financial advisors say, oh, I don't really follow the star system. Why? Why don't you?
because because they want to make the the most commission they can.
Yeah.
Yeah.
And ultimately, the MER comes out of your pocket. It comes out of the performance of the fund. Now you want to concentrate on the performance. You don't want to fixate on the MER.
Sure. I think you gotta have like balance, but yeah.
Yeah. And this is stuff that I talk to anybody that'll listen, but vast majority of people don't know. And they go to the bank, and if they go, not to pick on Royal Bank, but if you go to Royal Bank, they're going to sell you Royal Bank mutual funds. They're not going to sell you from other banks or from other companies because they want to collect both sides of the commissions and so they're going to sell you their own products. And are they going to be the best? No, maybe, but not necessarily.
Yeah, it's like the whole MER thing. Like, you need to be able to visualize like how much it takes a hit on your portfolio over
Yeah.
time.
Oh, sure,
See the
absolutely.
snowball, it could have been maybe 50 times bigger, 3 years down the road.
Yeah,
But with MER, it could have only been like 3 times growth. So what happened to this gap? This gap is what you're paying them. Like, it's like every percent kind of grows on its own, and you're just losing it out in on the front end. Like, these front end costs is like the most damaging because it stops your growth right then and there.
right then, yeah. I I think front end isn't really being done all that much, or it's usually like front end zero. And I
Yeah.
think deferred sales charges are illegal pretty much everywhere except for BC.
Okay.
And it's they're not really done anymore anyway. Like the money that the financial advisors make are usually just the trailers. They usually don't make that much money up front like they used to. So it's all kind of being squeezed, right?
Yeah.
And I think the MERs are, through competition and through disclosure, are sort of dropping as well. Uh, I don't know. Do you do mutual funds as well, or mostly stocks and ETFs?
Uh, no mutual funds for me. The only funds I buy are Vanguard index funds, Vanguard index funds.
Yeah.
Yeah. So, and their MERs is in like the 0.2 and 0.3 range.
So are they ETFs or mutual funds?
They're ETFs,
Okay. Yeah.
Vanguard index ETFs. Yeah.
But so if you didn't want to make the decisions yourself, which, like you and I enjoy the research to some degree, but if you didn't, then you would have to get a financial advisor that charges you separately as a percentage of your assets, or charges you by the hour or something like that, because there is no commission to be made off of ETFs.
Right. Right.
So
And the company I mentioned, Vanguard, you can just go to Vanguard Canada, and you can open an account with them and just buy their funds directly. So
mhm.
I believe the commission is like next to nothing. It's because they want you to buy their funds.
Yeah, the compound interest, I think, as you had mentioned, like some people think, well, if there's a 2% MER and instead of 7%, I'm going to make 5%. They think that over 30 years, that it's going to be proportional. But
No,
due to compound interest, you're actually losing 2/3
yeah,
of your income due to that 2% difference because the curves just go like this. So financial advisors, I think we're off on a tangent some time ago, but financial advisors, if they're good ones and they add value and they pick good investments for you and they check in with you, and when the market's crashing, they phone you and say, listen, it's okay. They talk you off the ledge and prevent you from selling at the worst possible time. They're worth every penny. But if you just get somebody who just does financial plan for you in 10 minutes by entering some stuff into some software, and here's a printout, and here's the most basic um, group of mutual funds according to your questionnaire that you filled out about risk. They're not adding any value. They're not talking to you about wills. They're not talking to you about insurance. So those financial advisors don't deserve the commissions that they make. So
yeah, yeah. Have you heard of the term? Was it fiduciary duty? Where the advisor should care about how your well-being more than theirs. Like if you meet a financial advisor, if you ask them if they have a financial fiduciary duty, and they answer yes, then they should care about you more than themselves. But I never met with a financial advisor. I never asked that question. I don't know if they answer straight up or if any of them do have that duty.
yeah, I think in Canada it's not a thing yet. I
Oh,
know in the US they used to have they had a big debate whether all financial advisors had to be fiduciaries, and then the industry fought back and saying, oh no, we don't have to, and so on.
then I guess by default, they just want to make more money for themselves, like you said.
It's a business, so I agree with you. I know there's a conflict of interest with financial advisors. It's unfortunate. Uh, the fact that they do want to be compensated for the work that they do. I mean, when I work, I want to be paid, right? Let's face it. So
It's good to
uh,
know how they're making the money, though. Like sometimes they hide things. I know someone who keeps switching funds, like without telling the client, and then they just keep switching, and then every time they switch, the advisor gets a cut. Like
yeah,
it's a criminal act, in my opinion.
yeah, that's called churning, right? Where
Yeah.
where they just do transactions. And my mother had a financial advisor who did that, and he's like, oh, we're just going to get you out of this and we're going to get you into this. It's going to be better. That was the only reason. I'm like,
Oh,
and it was something like, okay, we're going to sell Royal Bank and we're going to buy Bank of Nova Scotia, like that. That was the sort of thing. And
and
it's
then
like,
3 months later, it goes back to Royal Bank, right?
like each transaction was a percentage of the dollar amount. So it was like $800 on the sell, $800 on the buy. And I'm just like, so you just did something just to justify, having her as a client, and that's all you did. So when I first started, this was going back to the ignorance and not knowing about personal finance. Is I thought asking my financial advisor how he gets paid was sort of like asking him, what's your salary? That it
Oh,
was that it was taboo,
oh,
completely rude. And later I realized everybody's getting paid from my pocket. I'm the one who's shelling out the money. I'm the one who's taking a risk. Everybody else is getting paid, and it's coming straight out of my pocket.
yeah.
And so now I want to know how you get paid, and that way I know your motivations. I know what you want to do, and if I see that you're getting paid by the transaction and you're moving stuff around. I'm like, nuh-uh. Theoretically, fee-only advisors that get, well, okay, who get paid by the hour, right? They're the only ones who will really tell you the truth.
Well,
Uh,
you can still you can still like do like hours of
well,
research for you, hours of research. This
well, I mean, okay, I mean, you have to say, okay, how long is it going to take you to look at my
yeah,
portfolio and
you have to track it somehow.
give me an opinion, right? So if they tell you, well, it's going to take me 3 weeks and I'm going to bill you 120 hours, I'm going to say no, let's not do that. But if a financial advisor, even if they get charged even if they charge separately as a percentage of your assets, you still want to look out to kind of see how they're getting paid. I think that's important.